Welcome to Alpha Recap, your quick post-market wrap from stockalpha.ai. It's Jordan here with Sydney, and we're breaking down the tape from January 23rd. As always, if you have questions, you can reach us at stockalpha.ai.
Hey everyone, markets closed mixed today, and it felt like three big forces were duking it out. Earnings and corporate news, fresh regulatory headlines, and some wild weather driving energy prices. Plenty to unpack.
Let's hit the headline movers first. Intel and Capital One led the day in headline volatility. Both had developments that forced investors to rethink positioning. Meta caught a regulatory scare after UK communications regulator Ofcom opened a probe around WhatsApp data submissions. And in energy, Goldman Sachs said the recent spike in natural gas prices probably overshot fundamentals, putting some energy names at risk if the weather normalizes.
That sums it up. And remember, the calendar is still busy. There were 35 S&P 500 companies left to report this week, so headline risk stayed elevated. That's a recipe for dispersion. Some names ripping, some crashing, and a lot of event-driven moves.
Quick reaction. When you say dispersion, what do you mean for listeners who aren't market pros?
Good question. Dispersion just means stocks aren't moving together as a block. Instead of the whole market going up or down, individual companies or sectors are diverging based on their own news. That creates more opportunity for active traders and more headaches for passive investors who want a calm ride.
Right. Let's dig into earnings as the volatility engine. The market is still extremely sensitive to corporate results. Intel's earnings-related weakness reverberated through semiconductors, a reminder that even big chip names aren't immune to execution or cyclical pressures.
And Capital One's share price fell after it announced the Brex acquisition. That's a classic case of strategic rationale versus short-term investor concerns. People worry about deal price, dilution, and integration costs. When rates matter, banks get extra scrutiny on how M&A will affect net interest margins and deposit mix.
A couple of other examples mattered too. Small and mid-caps moved on their own micro results. Foresight Financial Group, for instance, reported GAAP earnings per share of $2.17 on about $15.3 million in revenue. Numbers like that can swing sentiment fast when people are watching funding and profitability closely.
Exactly. Micro results matter more in this environment because investors are hunting for information edges. If you're a fund running event-driven strategies, you're parsing every release for guidance changes, margin signs, or surprises.
Let's pivot to regulation. The Ofcom probe into WhatsApp data submissions put another layer of risk on Meta. Sydney, how should investors think about a regulatory headline like this?
It depends. On one hand, some regulatory inquiries are episodic. They add legal costs and time but don't change the core business. On the other hand, repeated probes can be structural, forcing product changes, fines, or even constraints on data usage that hurt ad targeting. Investors need to estimate the size of possible fines, ongoing compliance costs, and whether the company's product roadmap will be affected.
And don't forget, there were a bunch of Form 8K filings today. Podcast One, Next NRG, BV Financial, Huntington Bank Shares, Matador Resources, Next Cure. Those filings often contain officer turnover, contract terminations, or other governance tidbits that can move stocks between quarters.
Right. A steady stream of 8Ks tells you information flow isn't limited to earnings. If something material happens outside the calendar, that's when smart investors get an edge by reacting quickly.
Now, the weather story. Natural gas spiked on an extreme cold spell, and Goldman Sachs argued that the move likely overshot fundamentals. In plain English, that means the price jump was mostly caused by short-term demand from the freeze and could revert as temperatures normalize.
Right? That's the mean reversion thesis. If demand drops and storage refills, prices can fall back rapidly. But there's a counter-argument. Structural constraints like pipeline bottlenecks, storage problems, or underinvestment could keep prices elevated. So investors have to decide if this was a trading opportunity or a signal to reset long-term exposure to energy.
That's the crux of a big debate: temporary versus structural in energy. If you believe it was temporary, you might trim gas producers or hedge. If you think supply issues are longer term, you might hold or add. Either way, stress testing scenarios is essential.
Exactly. And Goldman's explicit call that the spike overshot fundamentals is a useful read. It signals how some big desks were positioning their clients and likely influenced intraday trading in energy equities and ETFs.
Let's return to M&A. International Paper completed the sale of its global cellulose fibers unit to American Industrial Partners. The price wasn't disclosed, and that creates a follow-up story. How will the company use the proceeds? Deleveraging, buybacks, dividends, or reinvestment all have very different implications for shareholders.
And Capital One's Brex deal shows the flip side. Acquisitions can be growth levers, but markets will punish unclear terms or perceived dilution. For acquirers, the financing mix, cash versus stock, matters a lot for near-term EPS and shareholder reaction.
Let's talk practical takeaways across investor types. For short-term traders and event-driven funds, this environment favored active positioning around earnings beats and misses. Tight risk controls and option strategies are useful when you expect headline-driven swings.
Long-term investors should be distinguishing episodic shocks from trend changes. For example, with Meta, quantify potential regulatory costs and product impact over multiple quarters. For International Paper, look at whether the divestiture meaningfully changes free cash flow and capital allocation policy.
Income investors should watch capital allocation signals. Divestitures and M&A can change a company's ability to pay dividends. If executive turnover or material agreement terminations show up in 8Ks, that might foreshadow policy shifts.
Energy investors need scenario work. Model a quick weather normalization in a few weeks versus a prolonged supply shock lasting a quarter or more. Your hedge books and position sizes should reflect which scenario you think is more likely.
And governance-focused investors. That string of 8Ks is a reminder to monitor director and officer changes, compensation tweaks, and terminations. These can be precursors to strategic shifts or opportunistic management behavior.
Let's zoom into some of the debates the market is having right now. First, energy. Is this a trading bounce or a secular repricing? The answer will be in how quickly storage refills and how producers respond. That transmission mechanism dictates whether you treat the move as short-term alpha or a long-term allocation decision.
Second, M&A, strategic versus dilution. Some investors reward bold deals that expand capabilities. Others punish if the near-term mechanics look bad. Capital One's reaction is a perfect case where narrative and numbers clashed.
Third, regulation, headline risk, or structural threat. With Meta and other big tech names, repeated probes can become multi-quarter value drivers or drags. It's not just fines. It's product constraints, oversight, and ongoing compliance that can compress margins over time.
Okay, action items for portfolio managers. Number 1, prioritize the earnings calendar. With 35 S&P 500 names still to report this week, keep a rolling watch list and predefine reaction plans for high-conviction positions.
Number 2, read 8Ks. Not every filing is market moving. But when you see Regulation FD disclosures, terminations of material agreements, or multi-item exhibit packages like the one NextCure filed, carve out time for a quick read. Those documents sometimes contain the first public clues about material events.
Number 3, stress test energy exposure. Run scenarios where weather normalizes in 2 to 4 weeks and where a supply shock persists for a quarter. Size positions and hedge strategies around the probability you assign to each scenario.
Number 4, treat regulatory probes as multi-quarter risks. For big tech, fold potential fines and compliance costs into your valuation multiples instead of dismissing them as one-off headlines.
And number 5, be pragmatic on M&A. Evaluate financing structure, dilution risk, and integration timelines. For divestitures, watch the company's post-sale capital allocation commentary.
Before we close, a couple of quick signals to watch this week. Earnings cadence for those 35 S&P 500 names. Follow up 8Ks from firms that filed on January 23rd, and any guidance changes from the companies that reported today. Also watch natural gas inventories and near-term weather forecasts. They will drive sentiment in energy for at least the next few sessions.
A quick explainer for listeners. What is an 8K and why does it matter? It's a form public companies file to report unscheduled material events. Think officer changes, major contracts starting or ending, or other things that investors need to know before the next quarterly report. Sometimes an 8K can move a stock more than an earnings release if it reveals something unexpected.
And when people talk about mean reversion in commodities like gas, it just means prices often snap back toward a longer-term average after an extreme event, assuming nothing structural changed in supply or demand.
Let's sum up with clear takeaways. 1. The tape on January 23rd reminded us that markets now trade on layered information: earnings, M&A, regulation, and transient macro shocks like weather all matter at once.
2. Active managers should emphasize event readiness and scenario work. There's a lot of dispersion to exploit, but it comes with the need for tighter risk controls.
3. Long-term investors should separate episodic noise from trend-level shifts. Repeated regulatory hits or sustained changes to capital allocation are the kinds of things that change valuation frameworks.
4. In energy, don't assume every spike is permanent. Stress test your assumptions and size risk according to how quickly you think inventories and pipelines will normalize.
And 5. Scan those 8Ks. They're small documents, but sometimes they carry big implications between quarterly reports.
That's it from us today. If you want the detailed list of filings or the numbers we referenced, we'll have links and a show note summary on the site.
Thanks for listening. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. We'll see you next time on Alpha Recap.